Welcome everybody. So in this video, I'm going to be talking about the housing crisis that's happening right now in United States and how you can capitalize on that opportunity. You see, you probably know about the movie Big Short, but later on I'll explain to you the movie Big Short if you don't know about it. And there was an individual who was able to make a ton of money from his investments because he saw a pattern with the economy. And I'm going to be sharing that pattern, the things that he did with you. So stay tuned for all of that information. And if you find any value in this, subscribe and share this content. So Big Short is a movie, and I'm going to explain it to you as simple as possible. So imagine there are people called investors who like to buy things to make money, right? They're capital allocators. So in the movie, there are a few smart people who noticed that something was not right with the housing market. And the housing market is where people buy and sell houses. Now, the smart people, they realized that some banks were giving loans to the people who can't really afford to pay them back. And it's like your friend that borrows your toy and he wouldn't be able to give it back because he didn't have enough toys of their own. So you can use a toy as an analogy, you can use a car as an analogy, but this is what made the housing market very unstable. So the smart people decided to bet against the housing market. They thought that the housing market would get worse and they would make money if it did. It's like if you bet with your friend that it would rain tomorrow, and if you win, and if it rains, then you win. And in the end, if your bet was right, you will see a lot of return from your investment. And it's important to know that the movie shows how the financial system can be tricky and sometimes not fair. And The Big Short is about smart people who saw a problem with the housing market and made bets to make money when it went bad. And right now, if you look at the current economy, there are a lot of people that are defaulting on their loans. The interest rates are very high. Unemployment is very high. And the reason why I'm bringing this up is that certain situation, or this situation is the same as the 2008 housing market, which is when The Big Short happened. And the smart people realized that some banks were giving loans to people who couldn't really afford to pay them back. And that is one of the signs. Now, I'm going to go into a deeper detail on what happened in terms of the economy. And imagine buying a new car, right? Or a new car, a new house, but you don't have enough to pay for it all at once. So you go to a bank and ask for a loan. The bank gives you money to buy the car or house or whatever you want, and you promise to pay them back over time, like a little bit of money every single month. Now, think about this happening with lots and lots of people who want to buy houses. Banks were giving loans to people who maybe didn't have a lot of money or a good job. These people were like your friend who borrowed your cars, but didn't really have enough money on their own. At first, it seemed okay because real estate typically goes up. But just like the value went up, something changed. Some people couldn't keep up with their loan, and because of that, they didn't have enough money. It's like your friend that couldn't give you back the money that he borrowed. So when many people couldn't pay back their loans, it created a big problem in the housing market, and the prices started going down because there were too many houses for sale and not enough people that could afford to buy them. This is like everyone started to sell, and suddenly no one wanted to buy at a high price they used to be worth. So the housing market became unstable because banks had given loans to people and the people couldn't really afford them. This is the instability that was a big part and caused the financial crisis in The Big Short. And if you are smart, you would make the right bet, see the patterns. This is happening in the United States. This is happening in Canada. I'm not too sure about the other economies in other countries, but Canada and United States is what I follow the most. I don't know the Britain economy, but economies are all connected. So I'm going to talk about the signals and the signs that people can afford to pay the loan. All right, I'm going to be talking about the patterns, the economy, the look on the micro and the macro, and the signs to look for a next big short. Because I'm trying to show you the opportunity here. You have to look at the high debt to income ratio. So when someone has a lot of debt compared to their income, it can be a sign that they might struggle to make the loan payments. It's like you spent most of your allowance on toys and didn't have much left for other things. Adjustable rate mortgages. Some people had mortgages where the interest rates could go up after a few years. But if the interest rate increased, then their monthly payments much higher, and some people can't afford them. This is similar to a lender changing the terms and suddenly costing more. Another thing that you have to look out for is the job loss or reduced income. If someone lost their job or had their income reduced, they might not be able to afford their loan payments. It's like suddenly you had less allowance to spend on your expenses. And looking at the macro level, so that what I first described is the micro level. Now let's look at the macro level when it comes to the economy. So housing prices decline. When many houses are put up for sale and not many people can buy them, it can lead to a drop in housing prices. There's too much supply, not enough demand. This can be a sign that something is wrong with the housing market or affecting the entire economy. Banks facing problems. That's another one. When banks have too many loans that aren't being paid back, they can run into financial trouble. This can affect how much money they have to lend to others, which influences the overall economy. Another macro that you have to look at is the unemployment rates. A higher number of people losing their jobs is a macro level sign that the economy is struggling. When people don't have jobs, they can't afford their loans, can further impact the housing market. So in The Big Short, smart people saw these signs and pattern, and they realized that the housing market was not stable and made the bets that it would get worse. They saw the problem both micro level and macro level. So it's like they were paying attention to the pieces of the puzzle of the economy, noticing when things didn't fit well and making decisions based on the observation. Now, let's look at solution. How can you position yourselves so you can cash in on the next big short moment? So becoming a successful investor like Michael Burry involves a deep understanding of financial markets and willingness to take risk. But here are just a few things that you can do to position yourself for opportunities. First, you have to educate yourself. Start learning about finance and investing. Read books, take courses, stay up to date with financial news, understanding how markets work. If you want me to share with you how the best strategy to do that, let me know down below, and I can share with you a free lessons and courses. I'm not selling you anything. It's going to be free, and all you have to do is like and share and comment down below. And comment, I want it. So the next one is going to be, you have to build your financial knowledge. Learn about different financial instruments such as stocks, bonds, real estate, derivatives, understanding the risk and rewards. You have to develop analytical skills, practice analyzing data and trends, learn how to read financial statement charts, economic indicators. These skills will help you spot opportunities. Most importantly, you have to stay informed. You have to continuously monitor the financial markets and economic news. Pay attention to the signs of the market bubbles, economic imbalances, or trends that could lead to instability. And the next part would be risk management. You know, if you're scared money don't make money. So if you have to understand that when it comes to hitting or making bets, there's probabilities and odds, and I talked about this in my last video. I will put it up at the end so that you can look at risk management in a different light. But you have to be prepared to lose money and only invest what you can afford to lose. Use risk management strategies like stop loss orders. And when it comes to shorting involves betting that the value of the asset will go down. So this is why it's called the big short. It can be very risky, but you can lose more than your initial investments. So there's a lot of things that you can do when it comes to short selling. And when it comes to short selling, you can short these things. You can select an index. So you can short a broad market index like the S&P 500, which represents the performance of a large groups. You can do inverse ETFs. One way to short the market is to invest in inverse exchange traded funds, essentially short ETFs that aim to move in the opposite direction of the index they track. So for example, S&P 500 goes down, and inverse S&P 500 ETF should go up. You can short a specific stock. So identify specific company stock that you believe will decline in value. You can open up a margin account to short a stock. You typically need a margin account in your brokerage. But you know, it's a lot of risk, and I'm telling you just the opportunity of what is happening and what could happen, and I'm positioning you so that you can expect, or you can position yourself so that you can reap or capitalize on this opportunity. People made a lot of fortunes during down market, during times in history when there was a lot of uncertainty. So if you follow the trends, then you are going to be in a good position. And obviously we have to look at the risk. You know, what are the odds of like this happening again, and why? So the occurrence of a financial crisis is obviously difficult to predict. Nobody knows what can happen. I don't know what can happen. These experts, these big funds, you just don't know what can happen unless you have like insider information and all of that secret stuff. But you have to look at one of the ways to predict or to see what can happen is you have to look at the economic cycles. So the economic cycles are just a natural part of the economy. There are periods of growth followed by periods of recession. So throughout history, there's always a period of growth and a period of recession. And the financial crises often happens during or after economic downturns. There's always bubbles. So we just had a market bubble back in 2020 to 2021, 2022, that we had a market bubble. Everything was inflated. The money printer was going brrr, printing like crazy. And bubble occurs when the price of assets like stocks, real estate, rise to unsustainable levels, driven by speculation and excessive optimism. When these bubbles burst, it can lead to a crisis. There's financial innovation. New financial instruments and practices introduce complexity and risk to the financial system. This was the factor in 2008 with the use of complex mortgage-backed securities. There's also regulatory oversight. The effectiveness of financial regulation oversight by government and institutions can impact the stability of the financial system. Weak regulations or regulatory failures can contribute to crises. And there's global factors too, which is, everything is interconnected of global financial markets, which means that events in one part of the world can have a ripple effect globally. International economic and geopolitical events can also influence the market stability. And the most important part is the behavioral factors, the human psychology. You have to be a robot sometimes when it comes to investing, and you have to also understand human psychology, because humans are the ones that are betting, and the ones that are going to be making a lot of decisions when it comes to the housing market or stocks, or everybody's FOMOing into something. So investor behavior, including herd mentality and overconfidence, can lead to market swings and bubbles. While it's challenging to predict when and how the financial crisis might occur, various measures have been put in place to reduce the likelihood and severity of such events since 2008. These measures include improved financial regulations, stress testing of financial institutions, and increased transparency in the financial market. However, financial markets remain complex, and you can never really predict the financial market, but it's crucial to understand and practice good risk management and stay informed about the economy and the financial developments. So I talked about the patterns, and that there's always a growth period and a recession period. So throughout the history, I'm going to just name a few examples of when that happened. So in 1929, there was a Great Depression. This was the most severe economic crisis in history. It began with a stock market crash in 1929 and led to a decade-long depression. It was characterized by bank failures, widespread unemployment, and severe drop in economic activity. 2000 and 2002. In the late 90s, there was a speculative frenzy in technology stocks, leading to inflated stock prices. When the bubble burst in the early 2000s, many tech companies went bankrupt and stock values plummeted. The savings and loans crisis, which was 1980s to 1990s. This is the crisis involving collapse of many saving and loan associations, similar to banks in the United States. It resulted from risky lending practices and regulations. So in 1997-98, there was Asian financial crisis. Some of the countries in Asia experienced severe economic crisis due to factors like overborrowing, currency devaluations, and financial market turmoil. So there's also another panic in 1907. The financial crisis in the United States led to a bank run and near collapse of the financial system. It prompted the creation of Federal Reserve to stabilize the country's banking system. So as you can see, in the history, there are examples of when the economy went down and when the economy went up. And by the looks of it, the economy is on a down spiral, but that's not necessarily a bad thing if you position yourself to take advantage or capitalize on that opportunity so that you can make an insane returns for your investments or your capital. So with that being said, I hope you found value in this episode podcast. I want you to like, share, subscribe if you find value. And if you want that free course in fundamentals, the markets, and analysis, comment down below, I want it. And also like and share this video to your social media. All right. Stay tuned and see you till next time. Peace.